Folks, I believe these 5 stocks are screaming buy right now. The markets have been crashing all week. The S&P 500 is back in negative territory year to date. Almost every sector is red. Technology down, financials down, healthcare down, consumer discretionary down. And almost every retail investor is doing one of 3 things right now: panic selling, doing nothing and hoping for the best, or watching from the sidelines wondering if the bottom is in. But here is what the investors who actually build wealth understand. The biggest wealth building opportunities in market history were not created during the easy times. They were created during moments exactly like this one. And right now I have found 5 stocks that are looking genuinely compelling at current levels with upcoming catalysts that most investors have completely missed. One of them has a Wall Street analyst price target implying 230% upside from today's price. One of them just made a deal with one of the biggest truck manufacturers in the world that could be a game changer. One of them is sitting on one of the most productive oil fields in North America with margins exploding at $98 oil. One of them is sitting on the only helium discovery in North America at a time when helium prices are soaring because Qatar just halted production. And one of them has a clinical drug trial data readout coming within days that could completely change the stock overnight. I am not going to tell you which is which yet, because the one I am saving for last has the kind of catalyst window that closes fast. Very fast. Stay until the end, because the number from the Wall Street analyst covering stock 5 is going to surprise you. Now I am going to present my case for each one, and then I want you to go do your own due diligence and be your own judge. Make sure you subscribe right now and hit that bell icon. Every single day, I bring you the freshest stock analysis here on Stock Alerts Daily. Do not miss a single one. Stock number 1. This is the smallest stock on the list, and the one most people have never heard of. But it has a Wall Street analyst by rating with a price target implying 230% upside from today's price of $2. This company is a technology solutions provider focused on cybersecurity and cloud infrastructure. They provide dedicated server hosting, cloud hosting, data storage, managed security, and consulting and technology implementation for enterprise and commercial clients across the United States. And some of those clients are names you definitely know, including one of the most powerful semiconductor companies in the world, one of the biggest technology hardware companies on Earth, and one of the largest software companies in history. This is not a company chasing customers. This is a company that already has relationships with the biggest technology buyers in the world. They have over 20 years of technology innovation history, multiple patents, and a client base ranging from small businesses all the way up to large enterprise accounts. Now the recent news. The company just extended a license agreement with an industry-leading data center provider through 2032. That is a 6-year forward commitment from a major data center partner, reinforcing a long-standing strategic relationship, supporting their continued focus on scaling secure, highly reliable digital infrastructure. Their CEO just participated in a major annual investor conference at the Ritz-Carlton in Laguna Niguel. One-on-one investor meetings. This is the kind of conference where institutional money starts paying attention to small-cap names. And just last week, the company released quarterly earnings. Total revenue for 2025 came in at $23.6 million. Q4 revenue was $6.13 million. The company recorded positive adjusted EBITDA in Q4. Cash from operations was positive for Q4 in the full year. $8.4 million in cash. And critically, no long-term debt, for a stock at $2, with a market cap of $25 million. Positive EBITDA, no long-term debt, and a Wall Street analyst with a price target implying 230% upside. The risk is real. This is a tiny float stock, highly speculative. Liquidity is thin. You can lose your entire investment. But the setup here is worth understanding. Obviously small cap, volatile, real risks. Do your own research. But the story here is more compelling than the stock price suggests. The company is Intelligent Protection Management. Ticker symbol IPM. Check NASDAQ.com for the current price before making any decisions. But stock number 2 has a completely different story. This company was once at $26 per share. Now it is a penny stock, and it just launched a solar panel product line and signed a distribution deal that could be its biggest revenue catalyst yet. Stock number 2. Just 18 months ago, Wall Street had huge expectations for this company. Analyst price targets of $108. $135. The stock was trading near $26. Today it is trading around $2.67. That is an 84% decline from its peak. But here's the part of this story that is interesting right now. This company makes lithium battery technology, advanced lithium-ion battery cells, battery pack assembly, full system integration, with a patented dry electrode manufacturing process that can deliver power solutions for energy storage, electric vehicles, commercial trucking, and consumer electronics. And their Battleborn Batteries brand is one of the most recognized names in the lithium battery space, with hundreds of thousands of reliable battery packs already deployed in the field. Now let me tell you why 2026 could be the year this story changes. In January, they launched their first ever solar panel product line, expanding from pure battery storage into integrated energy solutions. In February, they won dual honors at the 2026 SEAL Business Sustainability Awards for their breakthrough trucking power solution. They formed a distribution partnership with National Railway Supply LLC, making them the first lithium battery provider in the North American rail sector. And the biggest catalyst of all, a collaboration with one of the most recognized truck manufacturers in the world announced last year. That could lead to the commercial integration of their battery technology into a major commercial trucking fleet. If that integration moves forward, the revenue implications could be transformative for a company with a $24 million market cap. They have a patent portfolio of over 90 patents worldwide. 6 Wall Street analysts cover this stock. The median analyst price target is $18.75. That implies over 600% upside from today's price. The risk is very real. The stock is down 84% in 12 months. Losses are ongoing. Revenue needs to scale significantly. This is highly speculative. You can lose your entire investment. But a battery company with 90 patents, a major trucking partnership catalyst pending, solar panel expansion, and a median analyst target implying 600% upside is worth understanding if you have appropriate risk tolerance. The company is Dragonfly Energy Holdings. Ticker symbol DFLI. Check NASDAQ.com for the current price before making any decisions. But stock number 3 is completely different from everything you have heard so far. This company is not a technology play. It is sitting on one of the most productive oil fields in North America. And at $98 oil, the math on this one is extraordinary. Stock number 3. Oil just hit $98 a barrel. And there is one small American oil company sitting on over 50,000 acres in the most productive oil field in the entire world, the Permian Basin, West Texas. This company is an independent oil and natural gas exploration and production company focused exclusively on the Permian Basin. They operate hundreds of producing wells. They acquire and develop liquid-rich formations in West Texas. And here is what makes this story compelling right now. This company can produce oil profitably at $60 oil, not $98 oil, $60 oil. At $98 oil, their margins are extraordinary. Cash flow for 2026 could exceed $200 million if oil holds at these levels. The stock has been up over 60% year to date already, but the valuation is still remarkable. Forward earnings per share of $19. Forward price to earnings ratio of approximately 8. For a profitable growing oil company in the best oil basin in the world at $98 oil, an 8 times earnings multiple is historically very cheap. 2 Wall Street analysts cover this stock with a price target implying 70% upside from current levels. Insider buying has been reported in recent months. Management is putting their own money into the stock, and this company could become a takeover target. Large oil companies are actively acquiring Permian Basin acreage right now. If a buyout happens at a premium, the upside could be dramatically higher than analyst targets suggest. The risk is real. If oil prices crash, this will be one of the first affected. Smaller company means lower liquidity. Do your own research. But 50,000 acres in the Permian Basin, profitable at $60 oil, trading at 8 times forward earnings with $98 oil. Insider buying, takeover potential, is a compelling setup. The company is Ring Energy Incorporated. Ticker symbol REI. Check NASDAQ.com for the current price before making any decisions. But stock number 4 is nothing like anything on this list, because it is not oil. It is not technology. It is not batteries. It is something completely different. a resource that most investors have never even thought about. And right now, the global supply of this resource is in crisis. Stock number 4. Most investors spend their time thinking about oil, gold, natural gas. Almost nobody thinks about helium. And that is exactly why this opportunity exists. Helium is used in rocket fueling and space flight, semiconductor chip manufacturing, medical MRI machines, quantum computing, advanced energy technology, and electronics production. Every single major technology industry on Earth depends on helium. And the global supply just got hit by a shock that most investors completely missed. Qatar just halted helium production. Qatar is one of the world's largest helium producers. When Qatar goes offline, the entire global helium supply tightens overnight. Prices spike, and companies that actually have helium in the ground become dramatically more valuable. There is one exploration company with first-mover advantages in 2 helium provinces, one in Minnesota, United States, one in Greenland. Helium demand is expected to double by 2035. Supply has historically struggled to keep up. The U.S. Department of Energy and NASA have already begun funding programs to address the supply shortfall. This company is perfectly positioned to benefit from exactly the supply shock happening right now. 5 Wall Street analysts cover this stock. Not one analyst. 5 separate Wall Street analysts. The average analyst price target is 81 Canadian dollars. The low target is 69. The high target is 94. The current stock price is around $2. That is a supply shock story, with analyst coverage from 5 separate institutions, on a stock trading at $2. The risk is real. This stock is not on NASDAQ or NYSE. Exploration is speculative. Drilling results can disappoint. This is high risk. Only invest what you can afford to lose. But the supply shock is real. The analyst coverage is real. And the timing could not be more compelling. The company is Pulsar Helium Incorporated, ticker symbol PSHF on the OTC. Check the current price before making any decisions. And now stock number 5, the one I saved for last. Because this one has a catalyst coming within days. Not months, not quarters, days. And when clinical trial data drops for a drug targeting one of the most underfunded diseases in medicine, the stock moves fast, very fast. Stock number 5. Parkinson's disease affects 10 million people worldwide. There is no disease-modifying treatment currently approved. Not one drug in the world has been proven to actually slow or stop the progression of Parkinson's. Until now, there might be one coming. This is a clinical-stage biopharmaceutical company with a lead drug candidate targeting Parkinson's disease as a potential disease-modifying treatment. And they just announced that Phase 1b interim clinical trial data will be presented at one of the most important neuroscience conferences in the world. The data will show central nervous system target engagement, pathway biomarker effects, and early clinical improvement signals. In plain English, the data will show whether this drug is actually doing what it is supposed to do inside the human brain. If the data is positive, the stock moves dramatically. If the data disappoints, the stock falls dramatically. That is the nature of binary clinical catalysts. But here's the context that makes this interesting. The company has $8.8 million in cash. No outstanding debt. Cash runway through the end of 2026. They submitted an IND response to the US FDA in March 2026 and expect a reply within weeks. They are on track to start a Phase 2 trial in Q3 of this year. 4 Wall Street analysts cover this stock with price targets ranging from $5 to $10. The average target of $7.50 implies over 107% upside from today's price of $2.50. The drug also has applications in other neurodegenerative diseases, including Gaucher disease, dementia with Lewy bodies, and Alzheimer's disease. Multiple indications means multiple revenue opportunities if development continues. The risk is the highest on this entire list. Clinical stage biotech is extremely high risk. Binary outcomes. You can lose your entire investment overnight if data disappoints. This is not for everyone, but a drug targeting an indication with no existing disease-modifying treatment. Phase 1b data dropping within days at a major conference. For analysts by ratings, and a stock at $2.50 is the kind of setup that can move dramatically in either direction very fast. The company is Gain Therapeutics Incorporated, ticker symbol GX. Check nasdaq.com for the current price before making any decisions. Let me bring this all together. 5 stocks, 5 completely different stories, all found during the same market panic week. Stock 1, a cybersecurity and cloud company at $2. Positive EBITDA, no debt, 230% analyst upside, tiny market cap. Stock 2, a battery technology company at $2.67. 6 Wall Street analysts, 600% median upside, major trucking partnership catalyst pending. Stock 3, a Permian Basin oil company, profitable at $60 oil. At $98 oil, the margins are extraordinary. 8 times forward earnings, 70% analyst upside. Stock 4, a helium exploration company at $2. 5 Wall Street analysts. Qatar just halted production, creating a global supply shock. Demand doubling by 2035. Stock 5, a Parkinson's disease drug company at $2.50. Phase 1B data dropping within days. For analysts, 107% average upside. Binary catalyst. Obviously, all 5 of these are speculative. Small cap. Volatile. You can lose your entire investment. These are not recommendations. This is analysis for educational purposes only. Always do your own research. But market panic weeks create exactly the kind of setups that patient, informed investors look for. And these 5 are worth understanding deeply before you decide what to do about them. That is your 5 stocks for this market panic week. IPM, DFLI, RAY, PSHE, and GX. If this video gave you value today, hit that thumbs up right now. Subscribe and hit the bell so you never miss our daily stock alerts here on Stock Alerts Daily. Drop a comment below. Which of these 5 has your attention right now? And which ones would you avoid? I read every single comment. See you tomorrow with another fresh analysis. Do not miss it. And as always, nothing in this video is financial advice. These stocks are shared for informational and educational purposes only. Penny stocks are volatile and risky. Only invest what you can afford to lose. Always do your own research. Always check nasdaq.com for the current price before making any decisions. Investing involves risk, including possible loss of principal.